Management Accounting C370 Unit 7 Summary. According to SIM 2017, a firm will evaluate a proposal for new capital expenditure by considering if it improves a recognized problem. In this case, there are several techniques used for planning and evaluating capital investment decisions, that is both non-discounted and discounted. When it comes to non-discounted techniques, they include ARR and payback. Discounted techniques include NPV, IRR, and profitability index. Considering about ARR, according to Collier 2015, ARR is concerned with accounting profits. ARR is the profit after tax generated as a percentage of the initial investment. In other words, it's also known as the return on investment. Usually, ARR in early years is lower than in later years. This is because the asset has a higher depreciated value in the early years than in later years. So cash flows often grow and then they decline over the life cycle of an investment. And in the final year, when the asset is fully depreciated, the return is infinite. And this is because the ARR is based on an investment of zero. ARR can be calculated based on opening written down value, that is the historical cost minus the accumulated depreciation, then using closing written down value and using the average of opening and closing written down values each year. According to SIM 2017, ARR is equal to the average accounting income divided by the average level of investment, and this is used to approximate the return on investment of a particular project, may be proposed or existing. Considering the decision rule of ARR, if ARR exceeds the target rate of return, then the project is acceptable. Considering about the benefits of using ARR, according to SIM 2017, when calculating ARR, the profits associated with the investment and the investment is each averaged over the life of the investment. So ARR uses the accounting income concept rather than purely cash flows. So ARR adjusts accounting income for the non-cash flow items recognized in the income statement. Whereas the drawbacks of ARR is that it does not consider the timing of cash flows. Considering about the payback period, payback and discounted cash flow methods are concerned with cash flows from a project. Considering about cash flows, we will be looking at it in detail later. Cash flow is usually considered to be more important than accounting profit in capital expenditure evaluation because it is cash flow that drives shareholder value. According to SIM 2017, the payback period is the number of periods needed to recover project's initial investment. So the decision rule is that the shorter the payback period, the more acceptable the proposal is. The payback period can be considered as a measure of project's risk. So longer the payback, the higher the risk of the business. The benefits of the payback period is that a project's payback period can be compared with a target which is set to reflect an organization's acceptable level of investment risk, and it is to compute. And also it provides a next to immediate indicator of the cash flows of a project. Considering the drawbacks of payback period, it ignores the time value of money. That is, we can overcome this problem by discounting the cash flows and calculating the discounted payback. And also it ignores the cash outflows that occur after the initial investment and cash inflows that occur after the payback period. Also, reliance on the payback period leads to a management focus on short-term performance instead of long-run profitability. This is not a good sign. And however, some surveys show that the payback period is the most often used approach by organizations for capital investment decisions. Considering about the discounted cash flow analysis, according to SIM 2017, the discount rate is the rate of return that an investor will use to determine the present value of a cash flow. So a purely rational investor will set the discount rate equal to the return on an investment that it must earn for the investment to be financially acceptable. The minimum rate or the hurdle rate of discount rate is set at a premium to the risk-free rate. The risk-free rate is the rate which the firm can get form of cash investment in a government-issued medium-term security. And discounted cash flow techniques take time value into consideration. So this time value of money needs to be recognized in capital investment evaluations in order to compare investment alternatives with different initial cash outflows and different cash inflows over different time periods. The time value of money needs to be recognized in capital investment evaluations in order to compare investment alternatives with different initial cash outflows and different cash inflows over different time periods. Discount factor discounts the future cash flows to their present values using a discount rate or an interest rate that's usually the firm's weighted average cost of capital. That is the risk-adjusted cost of borrowing for the investment. Therefore, higher the risk of the project, the higher the discount factor will be. This considers inflationary effects too. We will be considering the inflationary effects later. Considering about the NPV, according to SIM 2017, NPV is the sum of the present values of a project's cash flows, whereas Collier 2015 points out that the NPV method discounts cash flows to their present value and compares the present value of future cash flows to the initial capital investment. And NPV is equal to the present value of future cash flows minus the initial investment outflow. Whereas the present value of future cash flows is equal to the cash flow multiplied by the discount factor. The payback period can be considered as a measure of project's risk. So longer the payback, the higher the risk of the business. The benefits of the payback period is that a project's payback period can be compared with a target which is set to reflect an organization's acceptable level of investment risk, and is to compute. And also it provides a next to immediate indicator of the cash flows of a project. The profitability index is defined as the ratio of a project's future cash flow to the initial cash investment. It is another discounted cash flow project analysis tool, according to SIM 2017. So if the profitability index is greater than 1, you got to accept the project. If it's less than 1, reject the project. So the higher the profitability index, the better. When it comes to the benefits of profitability index, a good indicator of uncertainties associated with predictions of cash flows associated with capital investment projects. Not only that, it incorporates timing of cash flows and time value of money. Whereas the drawbacks of profitability index is that profitability index rankings do not always correspond to NPV rankings. The derivation of the present value is a very important thing. According to Collier 2015, this can be done using tables. That's the normal method that we use, using the discount factor and multiplying by the cash flows, or as you can also use a financial calculator, if not an Excel spreadsheet, or by using a formula. So according to the formula, the present value will be equal to the future cash flows in n number of years, which will be multiplied by 1 over 1 plus r to the power n, where r is the cost of capital used as the discount factor. Considering about the strengths and weaknesses of NPV, according to SIM 2017, NPV takes into account all relevant cash flows associated with the capital project, which is good, and the time value of cash flows is explicitly taken into consideration, and it's consistent with the concept of shareholder value. But the implications of incorporating taxation effects into a capital investment appraisal could change a positive NPV to a negative NPV and consequently change the financial viability of a project. Considering about the IRR, as SIM 2017 points out, IRR is the discount rate that produces a net present value of 0. It is the averaged return earned on an investment over its lifetime. When the NPV is positive, the IRR will be greater than the cost of capital. And if the IRR is greater than the cost of capital, project is acceptable from an economic perspective. If not, the project would be rejected on a purely financial basis if the IRR is less than cost of capital. According to SIM 2017, a firm will evaluate a proposal for new capital expenditure by considering if it improves a recognized problem. In this case, there are several techniques used for planning and evaluating capital investment decisions, that is both non-discounted and discounted. When it comes to non-discounted techniques, they include ARR and payback. Discounted techniques include NPV, IRR, and profitability index. Considering about the situation of identifying whether we have actually improved a certain problem or not as a result of this capital investment decision, the first thing is capacity constraint problem. When we have a capacity constraint problem, we recognize it as an improved situation if the increased levels of market share and sales leads to increased income levels. And if it's a cost management problem, we recognize it as improved if better cost management gives rise to increased profitability. So for all of these capital investment decisions, a key concern is the risk-return relationship. According to Jury 2015, the expected return will be the risk-free return plus the risk premium multiplied by the risk of selected portfolio over the risk of market portfolio. The overall cost of capital is called the weighted average cost of capital. The weighted average cost of capital is equal to the proportion of debt capital multiplied by cost of capital plus the proportion of equity capital multiplied by the cost of equity capital. So to make the best decisions on capital investments, sensitivity analysis becomes important. We will be looking at sensitivity analysis in detail later.